When Elon Musk posted, quote, "I love Donald Trump as much as a straight man can love another man," it was seen as a surprising display of affection toward the president. But no one could have predicted that this relationship, resembling a soap opera, would end in such dramatic and parodic fashion. Now, after this public spectacle, Tesla shares are now down 21%, and investors appear to be reacting much like they did during the post-election euphoria that pushed the stock above $400. These investors were not betting on the company's strong fundamentals, but because they believed Musk's political ties would bring the company an advantage. In this video, we're going to explore whether it's actually worth buying the Tesla dip, or if this is just another hype-driven move investors might end up regretting. Aswath Damodaran, an expert value investor, who is well known for his deep analysis of Tesla, in his latest assessment, emphasizes that trade wars and tariffs can significantly impact companies with high foreign exposure. These businesses face greater risk because they depend on foreign supply chains or low-cost labor. He also mentions that we're living in an era of political uncertainty and economic nationalism. As a result, investors are demanding higher returns to compensate for increased stock market risk, driven by uncertainty, fear, and expectations of lower corporate earnings. In times like these, it's crucial to keep a close eye on the Fear-Greed Index, which reflects growing investor uncertainty. This is particularly important now, as current market conditions suggest that stock prices can drop sharply even in the absence of a recession. These rising risk perceptions lead to higher discount rates on future cash flows, lowering overall stock valuations and making current prices less attractive. Aswath Damodaran no longer sees Tesla as a strong long-term investment, and for good reason. The electric vehicle narrative has cooled down, largely because hybrids and gas-powered cars aren't going away anytime soon. Meanwhile, China's EV giant BYD has become a serious threat, already outselling Tesla globally in electric vehicles. On top of that, politics have crept into the Tesla brand that prompting some consumers to boycott the company due to Elon Musk's public behavior. What was once a green tech symbol has now become a polarizing one. While the stock did bounce after the elections, Damodaran is clear, the rebound isn't supported by strong fundamentals. Tesla has become the center of a political firestorm, and that brings risks that go far beyond the numbers. He explains that he didn't sell his shares because of business concerns alone, but because politics have now distorted the company's valuation. Based on his updated analysis, his latest estimate is around a very low $150 per share. Now let's look at the real numbers, starting with one of the most important metrics, CAGR, or Compound Annual Growth Rate. This figure measures the growth rate of an investment over a specific period, helping us see whether an investment has long-term growth potential. In our methodology, we analyze 3, 5, 7, and 10-year compounding rates for key fundamentals like earnings, sales, and net cash from operating activities. From 2014 to 2019, almost 5 years, Tesla's earnings remained negative, indicating the company hadn't yet reached sustained profitability. Since CAGR calculations only apply to positive values, the earnings CAGR can only be measured from 2019, the last 5 years, coming in at an impressive 70%. For sales, we see consistent growth strength, because both the 5 and 7-year CAGR sit around 50%, and even the 10-year CAGR shows a solid 41% growth rate. As for net cash provided by operating activities, the CAGR rates come in at a striking 76% over 3 years, 45% over 5 years, and 39% over 7 years. These are undeniably captivating numbers, but our analysis doesn't stop with CAGR. Let's move on to the next metric. Return on invested capital, ROIC, and return on equity, ROE, are two of the most important financial metrics for evaluating a company's profitability. They measure how effectively a company uses its invested capital and shareholder equity to generate profits. In simple terms, they show how efficiently the business is turning investment into actual returns. A higher ROIC typically indicates a more efficient and potentially more competitive company. Between 2014 and 2019, Tesla's ROIC remained in negative territory, and even over the last 6 years, the trend has been downward. Last year, the figure dropped below 10%, and only once in that period did it cross the 15% threshold. These numbers aren't particularly impressive and show considerable fluctuation. ROE paints a slightly better picture, but even here, the declining trend is hard to ignore. it's not enough to convince us that Tesla is delivering strong, consistent returns on equity in the long term.